It is now time to bring on our next guest. It is Michael Underhill, the CIO from Capital Innovations, LLC. And we're going to talk a little bit about if you got a lot of money laying around and you just got to find a place for it, well, Michael's going to be the guy. Just kidding, Michael. But you are going to give us some great insight on the future and investments and what's happening in the industry. Welcome, Michael.
Pleasure to be here.
Thank you so much. So I got a question for you. You know, the market interpreted what the Fed did in their announcement that the financial crisis is over and opened the door to raising rates. Can you speak to that? And is that the truth or what you feel is actually happening or going to happen?
Well, I think when we look at the world we live in today, we have what appears to be a more synchronous global economic upturn. And this is, we've been talking about this for years, but in January I came out and talked about how bullish we were about the global equity outlook. And we looked at earnings estimates. They continue to move higher. Our call in January is that we're going to see one of the strongest global equity markets out there since 2013. You look at it year to date, the MSCI All Country World Index is annualizing at about 25% year to date. So, our bullish global equity outlook assumes that earnings estimates are going to continue to move higher. I look at this global economic recovery. It continues to persist. You're starting to see inflation firming across a couple different inflation measurements and metrics. And you look at the pressure on the 10-year, and it's going to remain under 275. But I think we can all agree that we're starting to see things are firming. Inflation rates are ticking up, and so the Fed's got an eye on record low unemployment. They've got an eye on what's going on with this global economic recovery. And they're saying, well, we've moved from QE, quantitative easing, now to QT, quantitative tightening, in which they've already announced shrinking the balance sheet by about roughly $300 billion in the next 12 months. And they've already moved rates up just a little bit. And so I think, the notes, the speech yesterday, the rhetoric over the last 2-3 days, it's really been around, it's prudent to move towards a higher rate environment. And doing so in December, we're doing it pursuant to what we see as firming inflation numbers, firming employment numbers.
Now, Michael, I want you to hold on to that thought because we're going to get back to it, and we're not going to send everybody into a panic yet. So we got to take a break for a couple minutes, and we'll be right back with Michael Underhill from Capital Innovations, LLC, and he's going to just kind of enlighten us on what the future is with the rates and what the true facts are, or his interpretation of that. So we'll be right back. Thank you, Michael. Hold on. All right, welcome back to CEO Money. I'm here with Michael Underhill, the CIO from Capital Innovations, LLC. And Michael, on the other side of that commercial, you were kind of summing up your thoughts on interest rates and is the financial crisis over? And do we really need to? Do I need to really take a look at refinancing my house while interest rates are low? Let's just get right down to the third grade level of education here. I mean, because you're talking way up in the stratosphere. I've got to come down to what I understand, and our listeners. Tell me, do I need to panic? Do I need to refinance now? Or can I hold out another 6 months?
Well, I think when you look at, so your first question, excellent question about the housing market. The average person, if you're taking a look at all the cities in the United States, the average person with the average single-family home sees that real estate valuations in their home are close to, in most major areas, close to appreciating to where they were right around that 2005, 2006 mark. Some areas, whether it be California, even San Francisco, Seattle, places like that, they've seen greater price appreciation because of the technology boom. But the average investor, the average, let's just say, person that owns a single-family house, you've seen that price appreciation. So you're back to levels that we're seeing prices around that level of 2005, 2006. So your question about refinancing your home, I don't give advice about refinancing homes. I manage portfolios, but I look at interest rates. They're still at record lows. I've been in this business for 2.5 decades. we still have rates today where it may be advantageous to talk to your financial advisor and then take a look at your complete financial plan. You look at your debt, how much money you owe on your house, you look at your mortgage, look at the value of the house, and it may be prudent to go out and refinance your house at these low rates. You also need to holistically look at your entire portfolio. In other words, how much money you have in your retirement plan, whether it's a 401k or IRA. Are you maxing out your tax-deferred accounts in your IRA and 401k? If not, probably want to do that. So looking not only at the debt side of the equation, your mortgage, but also at the equity side and what equity you have in your house, as well as your investments in the stocks and bonds and other types of investment accounts. And so I would say it's a great time to reevaluate everything, whether it be your mortgage, looking at your home value, as well as looking at your overall investment portfolio, which quite candidly you should do at least 4 times a year, but at very minimal once a year with a qualified financial advisor.
So there you have it. I just took a Ferrari and I brought it down to the Volkswagen level, but you brought it out in plain sense. Thanks so much for answering that question, because
Of course.
God knows I needed it. But let's ratchet it up a little bit. You authored an acclaimed book on infrastructure investing.
Yeah.
Now we're going to take it to a whole nother level because, but that investor, that small investor too, he's got an opportunity to look at what's going on and to help be directed. Because when you're talking about infrastructure investing, is it becoming a good investment because what the president has done, and he's talking about, I'm going to get the government to invest into infrastructure for our country, and so is that what's going to make the change?
Well, so you asked a series of questions there. The first question is infrastructure investing, is it appropriate for the average investor? What I would say is it depends on your portfolio and your risk tolerance. But the first thing you need to do is look at infrastructure and say, what is it as an investment? Infrastructure, broadly defined, are essential services. So think utilities, transportation, energy, water and wastewater treatment, communications. Roughly, there are 800 publicly traded infrastructure securities. You can go out and buy real estate securities like American Tower or SBA Communications. You can buy utilities like American Water Works or other types of electric utilities like Exelon, and even alternative energy infrastructure. There are publicly traded companies out there where you can buy a security, an equity security, that will generate not only capital appreciation but income. And the income is tied to the underlying hard asset of infrastructure. So think cell phone towers, water and wastewater treatment facilities, different types of utilities. So you're getting that income in which the average investor needs some form of income in a yield-starved environment, yield-starved portfolio. So we think it's appropriate for investors to take a look at some of the more sophisticated institutional investors, whether it be California Public Employees Retirement System, Texas Teachers, great example. Britt Harris, he just left, but they built out their infrastructure portfolio, investing somewhere between 5 to 10% of the aggregate portfolio in infrastructure. So the average investor, if they want to invest like Texas Teachers or UTIMCO, they can actually go out and buy publicly traded securities or an ETF or a mutual fund that invests in publicly traded infrastructure to get income, inflation protection, and have an investment that's going to complement their common stock and bond portfolios.
It makes perfect sense to me. So you had, we're going to kind of go back just for a second. I want people to know who you are. You had a career on Wall Street. What inspired you to walk away from Wall Street and start your own firm?
Well, 16 years of working for some of the household names in the industry, I saw how things were done. And quite frankly, I noticed that as investment management firms got larger, the name on the door never changed, but people would migrate in and people would migrate out. But I looked at the governance, the corporate governance model with these large investment firms. They were focused on one thing, raising assets. They weren't focused on their clients. And so what I wanted to do was go out and start my own firm, invest my own money in our strategy so there's a congruent alignment of interest with the portfolio manager and the investors, and provide a clear and transparent governance model so that the investors know at all times how we're making our decisions, whether it be the top-down macroeconomic view on the portfolio, or even some of the short-term tactical outlooks where we provide investors a quick snapshot of what's going into the equity portfolios, whether it be fixed income, alternative asset classes, across the series of funds and strategies we run. We try and provide our clients an informed choice. So A, they know who they're hiring. B, there's an alignment of interest between the portfolio manager and the investor. And C, they feel like that there's a meaningful investment and the people that are running their money have skin in the game. Because when you look at the average portfolio manager at a large mutual fund company, less than 40% of all portfolio managers have $1 in their mutual fund.
Wow. Yeah, no, I get it. Speaking of that, what would you offer a new portfolio manager just starting out?
Well, I think that the first thing is you need to find a mentor in the business. I look at what's happened, and whether we go back to the global financial crisis, it seems like every 10 years we have some kind of credit crisis, mortgage crisis, financial crisis, and the lack of mentorship in this business is stunning, in my opinion. I was fortunate enough that I grew up and getting to know people in this business that took me under their wing and said, rule number one, don't do anything that you wouldn't feel comfortable doing in front of your mother and your father and as you get older, your wife and your kids and in front of a Wall Street Journal reporter. If someone asks you to do something you don't feel comfortable, don't do it, because in this business you will find that there's a lot of money at stake, and you could spend 2 to 3, 4 decades, a long time in which it takes to build up credibility, but it only takes 30 seconds to destroy that credibility, and we've seen that with many people in the Wall Street profession. So find a mentor and focus on discipline, tenacity, and focus on the long term. I'm a runner. I go out. I've done a 2 dozen or so marathons. It's about finding the pace that's comfortable, whether you're running an 8-minute mile, a 9-minute mile, a 10-minute mile. It's a long race. Investing's a long race. The investment professional career should be a long, slow and steady wins the race kind of profession. Unfortunately, you will find people that don't want to run at a steady pace, and they're not patient. Seek out a truly competent, ethical mentor to mentor you in this business when you enter the financial profession.
Michael, I really appreciate all your wonderful advice. It's been terrific having you on the show. It's Michael Underhill from Capital Innovations. Michael, how do they reach Capital Innovations, LLC?
You can reach us on the web. If you want to go to our website, it's www.capinnovations.com, CAPINNOVATIONS.com, or just drop us an email at info@capinnovations.com. If you want to pick up the phone and give us a call, 262-746-3100.
You've been listening to Michael Underhill. Thank you so much for being part of the show. Till next time, Michael, we'll talk to you again soon. We're going to take a break. You've been listening to CEO Money. We'll be right back.